Hallo und herzlich willkommen zu DPN TV. Wir freuen uns, dass Sie heute wieder eingeschaltet haben, denn wir haben heute zwei ganz spannende Gäste hier. Ich darf begrüßen bei uns im Studio Laura Cooper. Sie ist Head of Macrocredit beim Asset Manager Nuveen, und Mark Patrick. Er ist Head of Macro and Country Risk bei TIAA Financial Risk and Capital Management, dem US-amerikanischen Pensionsfonds für Lehrer. Laura and Mark, welcome to the FSZ Tower.
Thank you.
Mark, the current geopolitical situation is as risky and disruptive as it hasn't been in decades when I think of the Trump administration's policies and the military and trade conflicts in various parts of the world. What is your analysis? What kind of world will we be living in tomorrow, also in terms of fiscal policy?
Well, thank you, and thanks for the chance to address the audience. You're right. This is a risky and dangerous time, and one that we really haven't seen. I was thinking back to a time about 10 years ago when I was doing a similar kind of gig, and I was at that point working for JP Morgan in Hong Kong, and the Chinese government was headed in different directions on both geopolitical and macro issues in a way that we were concerned about. And I came across, at that time, an apocryphal Chinese curse. May you live in interesting times. It's probably one that you've heard. And I have to say that we are living through the most interesting times of our lives, sadly. I don't say that with any happiness, but the reality is that the Trump administration has come out in this current phase much more assertively than either its supporters or its opponents really expected. And that is creating an unprecedented level of disruption. And you see that across the board in the way that the United States is treating the Russia-Ukraine situation. You see it on tariffs, of course, and we'll have Liberation Day on April 2nd to see even more. But it's across the board on a range of other issues too. And so I think you're from Canada. We have challenges towards Canadian sovereignty, towards Greenland and therefore Denmark, a NATO ally. Panama, all of these things pretty much unprecedented. And then I would say, while the administration's come out very hawkish on China, there's also a lot of rumblings about a potential just shift in a deal with China of some form, all of which for American allies, whether they're the Asia-Pacific Treaty allies, of which there are 5, or NATO allies, this is very disconcerting. And I think in Europe, the key question ends up becoming, on Article 5 of the NATO treaty, can Europeans trust that the United States would come to their defense in a time of need? And I would just, answer that the best answer one could give is that we can't be sure any longer. And so I think it would be naive for Europe to operate on any other assumption than that America cannot be counted on in that regard. And that creates a very clear policy agenda very quickly for Europe. This is a matter of great urgency, though, for Europe, and I say that for a couple of reasons. One, there is already a war raging in Europe, and Russia spends more on its defense than all of Europe does at this stage. The ability to affect a planning cycle for military build-outs, which Europe is, in theory, at this point beginning to do in a large way, or that elite opinion would suggest that that's where Europe is headed. That's a 10-year cycle for the most part, and you're talking about a need to do that from the strategic nuclear level all the way down to the brigade level. And so this is a massive undertaking. And I would also argue that it's an undertaking that has to be done ahead of other major priorities, which we can talk about, which there certainly are in Europe. But the key thing then is, can Europe meet this, what I would call a hard power moment of truth effectively or not? That's really what it comes down to. And I have to say that out of the gates, the action has been impressive. And hats off to Mr. Merz, who yet is Chancellor in waiting, is not even in office, but has come out, I think, with the leadership and the guidance in terms of the direction Germany at the heart of all of this needs to go, and has worked really well with Macron, with Starmer, with the EC to create a common agenda and a path. And there's a narrative here that is compelling. And so with all of that, I think we will see a fiscal boost in Germany. I think over time this is going to be a half to a full point of GDP that could be affected from that. As an investor in Europe, that creates all kinds of potential upside, I would say. And I do think we'll see Europe getting to the 3% defense spending, NATO in general, and I think in the near term. And I think in the medium to long term, it's probably going to have to rise to 4 or 5%. Meanwhile, there's a big infrastructure bill that will take part, be part of this build out. So all of that is really, positive action early at the kind of elite political level. I think if you look at Europe in the medium to long term, and of course we are a long-term holder, so it's important for us to do that too. There, the questions become a little more difficult to answer. It's these are ultimately political questions, and the ability of Europe to meet this moment effectively is going to come down to the ability to sell these priorities to a skeptical public that has not been asked to make these sorts of sacrifices in the past, and it's not even clear what those sacrifices are at this stage. So I think that's really the question. Now, getting rid of the debt brake and paving the way for potential common borrowing, that's all happened. The question really then becomes, can you politically do this build of a coalition of the willing and have citizens come along with you on this path? If you want to understand, and there's sort of an 800-pound gorilla in the background here, and I feel this as an American trying to speak to this audience, if you want to understand, I think, the real disdain that has been evident in, say, the signal channel chats from the Vice President of the United States and from the Trump administration generally towards Europe, towards Canada, regrettably, I think you have to understand that in the case of Europe, as the administration having made the decision that Europe really can't meet this challenge, it's not really relevant to take seriously that Europe could become a cohesive, a guarantor of the liberal international trade order that the United States is stepping away from at this stage. And so it doesn't sort of merit the respect or seriousness that the political pronouncements that we're hearing in Europe might indicate. Now, I think it's way premature for anybody to make that assessment, and that I see a seriousness in Europe I have really never seen on these issues in my adult life, and including my time as a diplomat and all of that. Mm-hmm. So, but I think so much is at stake, right? So I think for Europe, this really is the biggest challenge since 1939. I think that coming out of the gates with the challenge from the Trump administration, creating that on top of Putin's aggression, creating a climate of concern and even fear that is allowing this response to take place. I think that's all very positive. I think the final chapter has yet to be written. I used to study history. That was going to be my first career, and I remember Chuck Yeager, who was the fighter pilot that broke the sound barrier, and he had a saying about moments of truth, and I set this up as this being Europe's hard power moment of truth. And he said, in moments of truth, there are reasons or there are results. So I think as friends of Europe, for us, it's really our hope that Europe achieves these results that it's setting out for itself. And if so or if not, I would say there's one other American from my history days that I would point to, that at the time of the Declaration of Independence, when the United States had very little, it hadn't formed yet, and had very little chance of defeating the British Army, Benjamin Franklin said, in I think words that could echo in European leadership circles today, gentlemen, we must all hang together, or we assuredly will hang separately. And I think that's the challenge that Europe has right now.
Mm-hmm. Thank you, Mark, for this analysis. Laura, we have just heard Mark's analysis, and he also mentioned some risks and uncertainties about which scenario and fiscal policy will come our way. How are these new constellations already affecting the financial markets?
Well, to Mark's point, we are in this period of pronounced disruption that certainly we haven't seen in our lifetimes. And I think what markets are kind of hoping for is that this would be a very similar U.S. administration to what we saw in the first Trump presidency. And that's clearly not playing out because of this degree of uncertainty around the tariff outcomes around what is the policy going to be, what is just the shifting in the global order that we're seeing as that U.S. dominance perhaps comes kind of less as it has been in most previous periods. So from a market perspective, we have seen U.S. equities come sharply under pressure, and instead we've seen a broad rotation to other equity markets across the globe, notably Europe, on the back of what Mark said about the fiscal stimulus measures coming through. And in fact, if we look year to date, European equities outperformance based on the Pan-European Stock 600 relative to the S&P 500 is actually a record differential. And it's very similar if we look at other equity markets like emerging markets like China as well. But what's been interesting as well is despite this risk-off tone that's emanating from the policy uncertainty in the US, the dollar hasn't portrayed its typical safe haven properties as well. The dollar has come under pressure. So that captures investors really not subscribing to that U.S. exceptionalism story anymore, but really looking to those other opportunities abroad. And that's why we've seen like the euro and the British pound continue to advance against the dollar. And then elsewhere, I think markets have been surprised by the extent of tariffs and just how prolonged the uncertainty around what measures are going to come through. So from an inflation perspective, because yes, tariffs will be inflationary, we have seen inflation expectations climb quite sharply. Notably, we saw that in recent U.S. consumer surveys. They were at multi-year highs. Now, while the Fed has come out and said, well, tariffs are likely going to be transitory from an inflation lens, markets are still skeptical that the Fed is going to be in a position to cut rates materially. So that has led to a higher for longer yielding backdrop. So treasuries continued to trade relatively range bound. And that's in sharp contrast to Mark's point around we're seeing a structural shift in terms of the European government bond market where German yields are materially higher and we see scope for them to climb even more. So ultimately, what we're seeing emanate from the U.S. is driving this rotation outside of U.S. assets after a prolonged period of U.S. exceptionalism.
Thank you, Laura. Mark, the major central banks initiated a new cycle of interest rate cuts last year. What monetary policy do you expect in 2025 in terms of inflation and economic growth?
Yeah, and here I'll echo things that Laura has said, of course, because the underlying theme right now is unprecedented levels of uncertainty. And the Trump 2.0 administration's come out and created a world in which that means that our ability to project macroeconomically what's going to happen, or for policymakers to understand their range of motion, that all gets limited. In that kind of a world, policymakers, investors, consumers all tend to pull back until they have greater clarity. And we just don't know when that clarity will come. So I think in the meantime, and for much of 2025, that just paints a picture of continued caution. And we're already hearing that kind of language from all of the key central banks that you mentioned. I think, look, the tariffs themselves, again, we don't know the depth, the duration, the full extent yet. But I think, they have surprised enough already that they'll create lasting macro impacts. The reality is that we're likely to see, I think, the pause that the U.S. started earlier in the year last for a good long time. The problem is this is a negative supply shock when you introduce tariffs at the global level and for the U.S. And there are forces moving in opposite directions because a supply shock like that's going to create, on the balance, stagflationary pressures. And we're seeing that. So part of what my team does is the macro scenario planning for the financial plan for the firm. And already on our monthly updates of the consensus forecast that we use for that, we're seeing creeping in higher rate levels, higher inflation expectations, lower growth levels in the United States, all at once. So this is beginning to form into the consensus. That'll affect the markets as well. And I think what the central bank is telling us, the Fed, is that we have pressures upward on rates from the inflation story. We have potential downward pressure if there's a big negative growth shock. But what I read in the Fed is that they want to see the whites of the eyes of inflation before they act again to lower. The earlier disinflation story is just not there for them. So while I think 11 of 19 policymakers are suggesting they still see 2 more cuts in the U.S. this year, I think the risks are to the downside that those don't even materialize because of the uncertainty. The ECB finds itself in a very similar situation at this point. Now, the disinflation story was stronger, but at this point, Lagarde is talking about, I can't remember, she's using words like unprecedented uncertainty. So I think there too, the ability to continue to lower rates, particularly as we're looking at a big fiscal expansion and the main engine in Germany, just starts to get more difficult. So I think pausing there is likely as well. And anyway, if the two cuts do happen, there's going to be a long pause at that point regardless. Bank of England have already paused on March 20th, and at a higher rate level, and they're certainly also looking at just data dependency going forward. Bank of Japan, I think, was part of the question, and that's a trickier story. There, was broad expectation that we would see rates go from 0.5 to 1 this year. I think that's still the expectation, that there'll be a couple more rate hikes. At the same time, it's really uncertain what happens to Japan's economy based on the auto tariffs and their duration, plus the other bilateral tariffs that might hit. That has the chance of kind of unhinging the yen to some extent, and those sort of depreciation pressures might speed the rate of potential rate increases in Japan. But equally, the negative growth shock story is going in the other direction and making things very complicated. So I think everybody's just going to pull back and wait for a minute.
Thank you. Interesting forecast. Laura, what consequences do these interest rate forecasts have for investments in fixed income and credit, and which asset classes and strategies currently offer institutional investors good return opportunities?
Well, echoing some of the points that Mark mentioned around kind of the broader macro picture remains one of upside risks to inflation, downside risks to growth, a Fed reluctant to cut. Perhaps central banks elsewhere will be in a position to have to cut to a greater extent because of the growth pressures coming from tariffs. So all of this kind of backdrop does suggest that we are going to continue to be in this higher for longer yielding backdrop, which does offer compelling income opportunities across fixed income. So fixed income is back in a way. And so the way of looking at this is, typically in this risk-off uncertain environment, we would see investors flight to U.S. Treasuries. But yet we're actually still seeing U.S. Treasuries hold relatively range-bound. One, because of the inflation risks, but as well the fiscal component. Do we need a higher term premium to compensate for the risks around that? So it's one of the reasons why we continue to be neutral duration in the US and actually seeking opportunities more within the credit space rather than looking at kind of the bond market in the US. So if we look about securitized credit, particularly in the mortgage-backed security space, is offering fairly attractive credit quality. Again, this higher for longer yield backdrop is supportive for that. And then kind of other areas, so we can think about municipal government bonds. So typically higher yielding does tend to be quite good quality. And as well, state and local governments in the US continue to have healthy balance sheets. There's ample liquidity. And so in this backdrop where valuations remain quite compelling, we are seeing that as an attractive asset class. And particularly for investors cautious on the U.S. Treasury front in extending duration, municipal government bonds does tend to offer that really attractive place to extend your duration in portfolios. And then I would say, even looking at some pockets of credit below the investment grade space, so senior loans, for example, is one area, just floating rate instruments that are going to continue to benefit from this higher for longer yielding backdrop without taking on that duration risk. And then finally, emerging market debt has actually performed quite well, but we're a little bit more cautious on that. It's about being very selective in that asset class. And that's to Mark's point. This is an unprecedented period of uncertainty where we could still see tariff risks come through more meaningfully on these countries, and as well potential for dollar upside if we do see more of this tariff drive a greater flight to quality that does still underpin perhaps a return to U.S. assets.
Mm-hmm. Thank you. Mark, the TIAA is one of the biggest pension funds and investors in the US. And how is TIAA adjusting its investment strategy to structural changes in geopolitics, or do current risk affect a long-term investor like your pension fund less?
Yeah, no, thank you for that question. And to the extent that listeners and viewers might not know, TIAA. We're about 100 years old. We're very unusual in the United States. We were formed by Andrew Carnegie, who used to use academics quite a bit in industry and realized that they were retiring without secure, retirements, and so he started TIAA back then. And so we're in the not-for-profit space, .org. We have a mission. We serve those who serve others. We're very proud of that. We have about 80% of the tertiary education market in the U.S., though, as a result, and that's a $300 billion portfolio. It is stable, broadly diversified, and we're overall AAA name, right? So those characteristics aren't going to change even with the geopolitical backdrop. That said, we are alive to the set of risks that the world is posing to us now, and have been for the last 2 years at least having regular communication with the board, with senior management about how these risks may materialize. And Laura and I are part of a geopolitical risk group that my team manages that meets every 2 weeks and evaluates these sort of shocks in the world system as they're happening and comes up with potential impacts on the portfolio, those sorts of things. But I'd say the main way that we deal with these issues is through scenario analysis. And so there's two forms of that. One is the standard stuff we do every year, where I mentioned earlier that we use a consensus forecast to do financial planning. My team manages that, but we also do downside shock risks to the economy, to tailored downside possibilities. And on top of that, starting really last year, we began to do more geopolitically or politically inspired scenarios that we do more like in my government days when we would do wargaming. And there, for instance, last year we did a China-Taiwan, a crisis hitting kind of close to war. We did a Trump 2.0, Trump wins and it's disruptive, so imagine. And then we take that information, we work with the Chief Investment Office, we work with our investment risk colleagues and understand what might happen to all of the assets we own if this less likely event were to transpire. And then we take that information and that whole crew at TIAA works with our Asset Manager Nuveen, and this is really the crucial part where we talk to the portfolio managers, to research, to Laura and her colleagues, and try to understand, are there ways in which this needs to, we need to address allocation or even the constituency of the portfolio overall. And significant money has moved on the basis of the analysis that we've done on this. This year, before the election, we had already begun to plan doing a couple of different scenarios. One is going to be kind of an economic fragmentation. The world moves more clearly towards a geopolitical great power rival model. And what probability we assign to that may be rising a little bit, but the reality is we'll look at that and we'll do the same kind of analysis, soup to nuts. The other that we're going to do, which may be of interest, is AI. And there it's going to be a two-tailed test, an upside and a downside. And the downside could be on security, actual defense kind of issues. It could be on job loss and those kinds of macro shocks. But there'll be these really upside ones that everybody's curious about as well, from increased productivity and kind of a way out of the kind of growth problems of the developed markets. Those are the ways that's the way we're approaching it.
Okay, thank you. Laura, let's look at Germany. Mark mentioned the future federal government wants to provide 500 billion euro for infrastructure through new debt. Additionally, there are debt finance expenditures for defense. Will this be the necessary breakthrough for Germany to position itself as a more attractive economic and investment market?
So Mark did touch on this briefly earlier, and to our mind, really what we saw from Germany earlier this year was game-changing. It really does mark a paradigm shift for the region, and it essentially warrants a rewriting of the European investment playbook. I mean, if we think about the direct implications of the infrastructure spending, about 500 billion added on the defense spending, to Mark's point, this is going to have a structural shift in terms of economic growth. Now, in the near term, it's going to be quite limited. They just don't have the capacity yet to kind of follow through on a lot of those measures. It will take time to implement. But starting in 2027, we've revised up our economic forecast for Germany anywhere from 0.7 to a full percentage point on an annual basis. That is quite a meaningful shift. And that is actually incorporating a fairly low fiscal multiplier. So there's even upside to that. I think in the near term, Germany is going to be more challenged from ongoing structural issues, and as well the tariff uncertainty, particularly on the auto front. But this does warrant just a rethinking of Germany, and it is a structural shift that we are seeing play through. And I think that does speak to what we're seeing in terms of bond yields materially higher. We're looking at an above 3% rate for the 10-year by the end of this year. That's going to drive the euro against the dollar structurally higher. Again, we're looking at 112 by the end of the year, obviously acknowledging the tariff risks in the near term. But then I think if we think about, okay, well, what are the positive spillover effects coming to the rest of the region? We do think there's going to be positives in terms of the sentiment, but as well, kind of defense spending for those regions that have the capabilities already, like France, is going to benefit from this space. Now, a key question that I'm asked is, okay, but what about periphery countries that are already kind of burdened by challenging debt dynamics? If they were to take on some of the lending provided by the EU, what does that mean from a spread perspective? And I think in the near term, we're unlikely going to see material defense spending coming through from those particular countries. And as well, for example, Italy, looking at the long duration profile of their debt, we're not going to see a meaningful impact of some of these higher yields feeding into that dynamic at this point. So I think overall, fairly constructive backdrop. Periphery spreads remaining relatively contained, the structural shift higher in yields, and overall, a European backdrop that I think warrants a repatriation of some of those flows that we have seen towards the U.S. and just garnering more assets under the kind of the European lens over the medium term.
Mm-hmm. Could I add a word on this? I completely agree with everything Laura said. I think I look at this in two phases, and so this initial phase is going to be really dependent on imports on the security side. Mm-hmm. Any of the actual benefits to GDP are likely to come on the infrastructure spend side, which could be significant. On defense, though, that's going to be a need to import from the United States in massive quantities. That creates a strange confluence of interest between the Trump administration and the Europeans to just make nice long enough to abide that common interest. I think, however, the incentives the Trump administration has been putting out there, the doubt about Article 5 and all of that, is leading to a medium-term to long-term rationale in Europe to do it on its own on every one of these weapon systems. And so the potential upside there is that, if you're having to do that kind of a defense build-out in an environment where high-tech is becoming a bigger part of the battlefield and all of that, then it's going to incentivize Europe to do things that will have long-term R&D benefits that can therefore increase the productivity story that's so plagued Europe, in recent years. And so it's a chance, like a potential way out. Again, though, I come back to the politics, and I would just say the question is, is Europe up to the task? I think ultimately making all this succeed means cohering as a collective against all odds to kind of make all this happen and achieve this positive story in a way. And weirdly enough, it's the best path to the best relationship between the United States and Europe over time as well. But I think it does take, the leadership of, merits of a Macron, of, looking in the eyes of the 20-year-old, as well as the pensioner, and saying, these are sacrifices to prioritize early because the growth effects are going to be more minimal initially. And you wanted to focus on environment, you wanted to focus on your pensions, on childcare. Instead, we're going to have to do this other thing because it matters. But hey, there's going to be a need for you to sacrifice. There's going to be a need for service. And ultimately, we're doing this to protect you, so there's going to have to be a need for you to understand that this is a mission worth fighting and dying for if it comes to that. These are messages that I don't think European citizens or European leaders are used to kind of communicating. And that's the next sort of step in the political evolution that probably needs to happen if that positive story is going to take off.
Yeah, this message is really central and really important. With a request for a brief answer, what should investors particularly focus on in their asset allocation?
I mean, I guess what comes to mind is diversification. So diversification across asset classes, whether that's incorporating a core fixed income, but as well looking across the credit spectrum, incorporating private credit as well in this backdrop, and then looking at geographical exposures. Yes, U.S. exceptionalism has been the predominant trend. We're still going to see the U.S. potentially be kind of that ballast in portfolios on the long term. But again, it's looking at those opportunities outside of the U.S. and taking a more holistic approach to this new world we're in.
Thank you. Would you like to add anything?
Well, there was one theme you asked about in the first question that I didn't really touch on. So if you provide me a second, maybe you asked about the fiscal. And that again is a big part of the backdrop to everything that we're discussing here. So we really have been dealing with a decade of debt accumulation, and that's been true across the world, developed markets, emerging markets. The problem with this, of course, Germany's a bit of an exception here, but nonetheless, this is the case globally. And the problem with all that debt accumulation is that it limits policy options and flexibility, makes you more brittle in the face of crisis. And so now we have this one test in front of us, the Trump policies on tariffs, the security crisis. But it's very easy to think about others, right? There could be another pandemic. There could be a war. There could be a climate tipping point. All of these things. And so what I would argue is that the developed markets have left themselves more vulnerable, but that even more vulnerability exists for the emerging markets on this front. Now, in terms of just the fact that we've moved this direction, I think there's a really interesting political science project that's been done between German and US political scientists called the Project Manifesto, looking across the globe at the manifestos of political parties and showing that it's very clear over the last couple of decades they've moved far from fiscal conservation and rectitude to spending. And we've seen that in the results. Certainly expecting in the U.S. case, barring some unusual flip that takes a bite out of our social transfers, which I don't think is likely, we're going to see much greater deficits going forward from a bad starting point. That's true probably for France and for Italy as well. And in Germany, of course, we'll be spending in debt financing into this current set of needs. Now, having said that, look, I'm not saying that it was wrong for these developed markets to spend into the crises that they dealt with. Let's face it, it's been almost 2 decades now. Global financial crisis, the sovereign debt crisis in Europe, you had the pandemic, you then have the energy shocks in Europe, especially from the war in Russia, Ukraine, and all of these things there's no way that governments cannot deal with those things. So they used balance sheet to do that, and they debt financed, and that just leaves us more vulnerable to these other potential shocks. But at the same time, all the structural problems that developed markets are dealing with, they don't go away either. The demographics, the climate challenge of it's going to cost more later if it's not paid for now, it doesn't just magically disappear. So, and we have left ourselves with less room. In the emerging markets, the problems are much more acute. So in the developed markets, this is a problem, but it's not a crisis because this can run for a long time before you end up like the UK having a Liz Truss moment, generally speaking, in markets. And I don't think the US or the core European powers are kind of close to that. In emerging markets, which have also ginned up a whole bunch of debt in recent years, I think we're already seeing some of the effects of less investment flows going to them and quicker actions by rating agencies to just effectively show that the credit quality and credit worthiness of those sovereigns is depleted. And they're now weaker, dealing with a situation that is worse for them, because I would say that tariffs, climate change, a potential war, all of these things, these are things that hit them harder. And particularly if there's conflict, that's going to be fought on the kind of grasslands of the global commons that these emerging markets depend on. So, the need for all of us to stabilize this for the sake of the emerging markets is quite high as well. Stein's law holds that, as you know, that anything that can't go on forever will cease. So this debt accumulation, it will end at some point. The question is, does it end through measured policy, in an orderly way, or does it happen through crisis and inflation and other kinds of disastrous outcomes? That comes back to these political questions that, right now, I would argue, in much of the world have been trending the wrong direction, certainly in the United States. But that's where we have to pin our hopes, is that citizens and their governments begin to respond to this issue in an effective way, so that it's good for the welfare of all.
Mm-hmm. Yeah, Laura and Mark, thank you very much for this very interesting interview. Meine Damen und Herren, vielen Dank für Ihre Aufmerksamkeit. Wir hoffen, dass wir Ihnen heute eine ganze Reihe von Aspekten zur Geopolitik, aber auch zu makroökonomischen Entwicklungen und letztlich auch zu Auswirkungen auf den Kapitalmarkt, auf die Investmentpraxis geben konnten. Wir freuen uns, dass Sie dabei waren, und gerne bis zum nächsten Mal.